This is a variation of the presentation I give asking what wealth means to you. I'm about to give it to a group of dentists, so there's a few dental slides, but here goes, it's an updated version. You are here, we're here. We're all here physically, some of us in spirit, more than others, especially after a long day of listening to presentations. But I don't mean that in just the physical sense. I mean it in the, I guess you could say, the woo-woo sense. We are all here in the sense that our own personal stories have led us up to this day, to being in this room all together. We're all different. We all have different fantasies, fears, dreams, desires, values, and priorities. And that's something that's really central to this presentation. Some of us like black jelly beans. Some of us don't. Some of us like Will Ferrell movies. Many of us don't. Some of us like pineapple on pizza. Some of us cannot stand it. We're all different. And that's one of the central things to keep in mind in relation to what you listen to here in this presentation, and in relation to anything you read, any advice you receive, whether it relates to money, whether it relates to important life decisions. It needs to come back to you and what wealth means to you. So you could be the most financially rich person in the world, but you could be miserable and poor health and not have any friends. And I don't know, by my definition, that's not wealthy, by my own idiosyncratic definition. And my definition of wealth is probably going to be different, slightly or largely, from your version. Keep that one in mind. So it is one of the things that I find very interesting as a financial advisor. I chat with lots of clients, and I can have two sets of clients who can be in objectively financially identical situations, essentially. Same age, same asset position, similar levels of income. And the advice I can provide might be very simple on each case, but profoundly different based on the types of people they are, what their goals are, and what really matters to them and keeps them up at night. So keep that in mind in relation to this presentation and in relation to any financial or lifestyle decision you make. You do you. Now, in this presentation, I'm going to talk about investing and some rules of thumb. I'm also going to touch on insurance as a tool for managing risk. But before I go there, I just want to share one little secret in terms of getting into a good financial position over the long run. You ready for it? Spend less than you earn. Over the long run, savings rate is probably going to be have the biggest impact on your long-term trajectory than any other decision that you make. Now, it's not always going to be the case that not every year you're not going to save the same amount every year. In some years you may actually spend more in certain years. Life has many stages, and there are periods of your life where you face headwinds. There are periods of time where you face tailwinds. When you're at university and you're studying, you're probably going to be earning less than you spend. When you're at the start of your professional life, when you've got young kids, you're probably not going to be saving as much as you might once you're an empty nester and at the peak of your earning capacity. But the key thing to keep in mind over the course of what's hopefully long, healthy, happy professional careers is that you spend less than you earn. Now, there is another aspect to this. It's also important to earn more than you spend. And it might seem that I'm saying the same thing there, and that's a bit of a tautology, but they are two slightly different things. When I talk about spending, I'm focusing on spending. When I talk about earning, I'm talking about earning. Now, there are some financial gurus, like the Barefoot Investor, Scott Pape, who will say that what you earn doesn't make a difference, but it does. I mean, the more you earn, the easier it is to save. I mean, I've got lots of clients who have more than enough income, more than enough wealth to satisfy their day-to-day living expenses. And one of the big parts of my conversation is to challenge them and push back. Are there things that they could spend more money on that would increase the quality of their life? I mean, it's not like life's all about accumulating the most wealth to leave when you pass away. What I find is that, especially with those wealthier clients, there is a natural limit to how much you can spend, and it's actually probably lower than many people would think. I mean, there's only so many pairs of pants you can you can wear. There's only so many cards you can have wear until it actually becomes a hindrance or a burden on you rather than something that increases the quality of your life. Getting to a position where you can earn more than you spend, and so that savings and savings rate is easier, is a really valuable part of the process of building wealth over the long run. So I'm going to talk about some investing rules of thumb, but first I just want to mention that there are a lot of ways in which you can invest. And I'm a financial advisor, so people normally come to me with the expectation that I will advise in relation to financial assets. But it's important to keep the other forms of investment in mind. So one way of investing is to invest in yourself. And everyone in this room has probably done that by going to university or getting some level of education. That's a form of investment in yourself. And it's not something that's tangible necessarily. It's not something that will show up on your balance sheet or anything. But the flip side is that it won't ever be able to be taken away from you. And as well as that, investing in yourself and in your education will often pay financial rewards, but it can also be rewarding in itself. And again, this all comes down to what you consider wealth to be for you. Common way of investing for many people is in property. I won't touch on that in much detail in this presentation. Another way is in businesses and ventures, such as dental practices. Now, it's worth noting that, this is the way that most people who become very, very wealthy, this is how most people make that wealth. You don't hear of many billionaires that make their money by putting their funds into KiwiSaver or whatever equivalent, or low-fee index-based managed funds. It is usually through setting up businesses and adding value in that way. And for a lot of people, you can generate a much better return on your investment by investing in businesses in which you have some direct control than you could by just putting that money into the share market or into direct property or anything of that nature. The corollary to that is that investing in businesses and ventures in a bad way can often be the best way to turn a large fortune into a small fortune. And again, this is an interesting aspect of when you look at very wealthy people. Very rarely do people lose substantial amounts of wealth by spending too much. It's normally by making really inappropriate investments. And so it's really important. So you can invest in businesses and ventures. Good chance it's one of the best ways of generating really great returns. But it's also one of the riskier forms of investments that you can make. And it's really, I would say it's important to make sure that you're able to add value in that investment, and that will involve your time, skills, expertise, knowledge as well. Another way, financial assets. That's probably what I'm going to touch on primarily here. That might include money under the bed, savings, money in a savings account, term deposits, other fixed interest investments like managed funds, invest in bonds, shares, property, listed property trusts, managed funds that invest in some combination of all of them. And there's more, but I won't cover them for the purpose of this presentation. So here, I'm going to talk about some investing rules of thumb. They're rules of thumb. They're not rules. They're guidelines. They're not laws. Again, keep this in mind. Every decision needs to be based on you, what you want, and your circumstances. Now, when it comes to investing, I would say the most important decision that you need to make is getting your asset allocation right. Now, that might sound like a complicated set of words, but it's pretty straightforward. So basically, what it comes down to is what distribution, or how are you going to allocate your investments taken together, and how should they be invested in defensive versus growth assets. Now, defensive assets are investments like cash and term deposits. The characteristics of these sorts of investments are that your money's pretty safe. It's not going to go up and down over time substantially. And the corollary of that is that the returns that you get from these sorts of investments will tend to be on the lower side. If you're lucky, you might get a return that's a bit over the rate of inflation, but you generally won't get much more than that. The key with defensive assets is you're minimizing the short-term risk of volatility, ups and downs, But hopefully, in return for that, you're getting capital preservation. Growth assets, on the other hand, and in this you might include shares, property, listed property trusts, investments in businesses, and the like, are investments that can go up and down, sometimes quite significantly over the short run. So volatility is usually a key characteristic of these sorts of investments. The flip side of that is generally you'll get better returns over the long run by investing in growth assets. So it's really important to find the balance that's right for you. And with any investment, whether it's a defensive or a growth investment, there are risks involved. Sure, growth assets have a high risk of volatility in the short term, but by investing too heavily in defensive assets, too conservatively, you're actually running a risk of potentially ending up being in a worse position over the long run. Finding the balance that's right for you. And there's a number of factors that will determine this. So one of them might be your personal tolerance for risk. What keeps you up at night? That might be influenced by, I don't know, everyone has a slightly different propensity towards taking on risk or not. Everyone has different experiences and perceptions of risk as well. Another factor is your cash flow needs. So you might be the most risk-taking person in the entire world, but if you need cash to pay for a deposit for a home next month, that money should not be invested in a way that it could potentially drop in value by 20% over the course of that month. So your cash flow needs over the short to medium term can be a really big factor in terms of finding an allocation that's right for you. Just from a practical example, I mean, this is how it might be broken up, and again, it will come down to you and what your needs are. So you can see you've got the defensive assets in cash, term deposits and bonds, and you might have some growth investments in shares or listed property if we're looking at financial assets only. So another rule when it comes to investing is don't put your eggs in one basket. Again, there are exceptions. That's how people become billionaires, by putting all their eggs in the one basket. But most of us aren't billionaires or don't necessarily want or need to become billionaires. And for most people, making sure that your eggs are spread across lots of different types of investments is it's often referred to as one of the few free lunches when it comes to investing. If you're invested across hundreds or thousands of underlying investments and companies, it doesn't really matter if one particular company goes really poorly or not. There'll be other companies that will offset that performance. An example might be if you've got shares allocated in Apple and Samsung. Apple might release an iPhone that goes really poorly, and Samsung might benefit from that with additional sales of its own investment. And you can have exposure to both the pros and the cons in that sort of situation. The more you invest into any, the less you invest and significantly into any one underlying investment, the less you need to worry about how that particular investment goes. Another thing I'll add is that to the extent possible, you should try to avoid paying unnecessary fees. The world of finance is an interesting one compared to many other domains in life. And one of the areas where finance can be quite different, or investing in particular, can be quite different to other areas, is that in a lot of domains in life, the more you pay, the more you get. So the general rule is that you pay more for a good or service and you'll get a better quality of good or service. It's not necessarily the case when it comes to finance. And in fact, it's often the case, it's often the opposite. And there's a fair amount of research that shows that the amount of fees you pay, investment management fees for instance, that's actually negatively correlated with your investment outcomes. So it's one of the actual more reliable things you can look at. The lower the fees you pay, the better your investment outcomes tend to be. Warren Buffett, famous billionaire investor, has a great saying. He says, fees never sleep. And he's a big advocate of investing in the lowest fee manner possible, which is usually index-based, widely diversified, low-fee funds, in which I largely agree with him. The other thing that's interesting about finance is that there are lots of areas in life where good things come to those who hustle. Put in a lot of effort, put a lot of energy in, make lots of little changes, and you'll get great outcomes. Not necessarily the case with finance. And in fact, there's a saying that trading is bad for your wealth. And there's a lot of evidence that the people who just sit and forget are the ones that end up in a better financial position over the long run. So, to the extent possible, keep your financial affairs simple so you can sit and forget. For a lot of people, the ideal situation is to maybe consider your circumstances and your needs, develop a plan, set everything up, then forget about it for 12, 18, 24 months. Make changes if your circumstances or your needs or your objectives change, but really set and forget and review periodically. It doesn't have to be much harder than that. So the way I kind of characterize it is you should make your finances boring so you can make the rest of your life interesting. One final comment when it comes to investing and developing your own financial plan as well is that no one has a crystal ball. No one can provide you with certainty. The best as an advisor I can provide to people is to provide some degree of comfort or confidence in the face of uncertainty. Anyone who thinks they can tell you what will happen is, in my opinion, revealing more about themselves than are revealing about what the future will hold. And you know what? The fact that there's a lot of uncertainty in the world, that's okay. I mean, in fact, that's what makes life interesting. If you knew exactly what was going to happen, life would probably be pretty boring. So we just need to accept this, both in our individual plans and when it comes to investing. And here is probably where I'll share one of my biases when it comes to investing and the reason for that. So I've got a pretty strong bias for investing in managed funds that are widely diversified, index-based, and low fee. That's referred to as passive investing. There's a lot of room for good faith debate. There are some people who think that you can pick the market and generate better returns by that, and that's usually referred to as active investing. So, the challenge with active investing, whether you're doing it yourself, or you're paying a financial planner to do it, or you're investing in an actively managed fund, is that you're basically trying to predict the future. Sure, you can look at the financials of a business and try to work out what the value of that business is based on its asset position, based on its income, historical income and profitability. But really, what you're trying to do is put a price on its future prospects and what its future income will be and what the value of its shares will be over the long run. That's based on a whole lot of factors that are virtually impossible to know. I mean, there's changes in people working for the organisation. There'll be technological changes. There might be regulatory changes in competition. And that's all nestled within a broader framework where, it's hard to know what the future holds. I mean, what sort of social, technological, economic, environmental, political sort of events are going to occur and what impact will they have on any given individual business. So it's a challenging thing to do. Now, there are a lot of investment managers out there. I've met many of them, and to a person, they're all really smart people. They're all well educated. They're all well resourced, heavily incentivized to try to beat the market. The challenge is, whenever they're buying or selling a share, at the other side of a transaction, and most transactions, it's another intelligent, well-educated, well-resourced, highly incentivized investment manager. If you are trying to pick an investment, or I were to try and pick an investment, at the other end of the transaction is probably another one of those investment managers. But it's harder than that as well. It's because it's not just one investment manager versus another, but the value of any given share is the collective or consensus view of all of those investment managers trying to work out what the future holds for any given stock. So the price of any share really is the consensus view of all of these people trying to pick what the future value of this investment is going to be worth. I don't think I'm going to be able to beat them. I personally don't think I'd be able to pick anybody who is able to beat them. So with kind of index-based investing, what you're doing is you're buying the value of a basket of shares at its current value. You're not trying to beat the market. You're trying to make sure you're not beaten by the market. And because you're not having to pay for all these investment managers, you are reducing your fees. And because of this, you're almost always going to be in the top half, if not the top quartile of investment funds. And that may not sound like much, but you do that consistently over time, you'll end up in a better position than you probably will be by trying to pick stocks or investment managers yourself. No one has a crystal ball in relation to what returns you're going to generate either. And this chart looks a bit messy, but it's one of my favourite charts in the world of finance. What it represents is $1 million invested over the course of 30 years' time. Now, I'll save you from counting the number of lines and colours there. I think it's about 114 or 118 different lines. They all represent the same investment portfolio. They're all based on historical data. The only difference between each of those lines is the year that 30-year period started. So one of those lines represents a 30-year period starting 1905. 1929 for the Great Depression, 1930 the year after it began, 1939, 1945, 1960, 1967, the Beatles released Sgt. Pepper's, 1980, 1987. Every single one of those lines is very different from the other. I can't tell you, if you were to invest $1 million right now, which one of those lines your investment outcomes would look like. And again, I personally don't think anybody else can tell you that either. What you can see is there's a general upward trend. What you can see is that there are some situations where you'd end up very, very well off, some less well off, and there does tend to be a bit of a cluster within a certain range. All I can tell you is to invest in a way that's appropriate according to you, your circumstances, your needs, your objectives. I can't tell you which one of those lines are, and no one can. So we've talked about investing, and when it comes to investing, one of the things to keep in mind is that in order to win, you need to make sure you don't lose. And there's a lot of people, probably a lot of people in this room, for whom the best thing you can do is focus on defense rather than attack. Sometimes, if you don't need to take on a risk, if you don't need to generate additional wealth, then perhaps it's not necessary to do it. And that's just, again, something to keep in mind based on your goals and your tolerance for risk and what you want to achieve. It's also relevant for insurance. I like this, and it will resonate for many of you. Dentistry is not expensive, but neglect is. Sometimes the best thing you can do is to make sure bad things don't happen. It's all about managing risk. I'm going to cover insurance very briefly, but before I talk about insurance, I do want to mention that insurance is just one tool for managing risk. There are lots of ways of managing risks, and insurance is just one way. And basically what you're doing is you're paying somebody else premiums, they're pooling your risk with lots of other people, and they're taking on a risk on your behalf. You're basically transferring risk and paying in order to do that. Life insurance is a good example in terms of demonstrating how you can manage risk. You can pay somebody money to pay your loved ones a lump sum if you were to pass away by a certain time, by a certain age. But you can also take steps to minimise the risk associated with passing away prematurely. You can make healthier lifestyle decisions, like not smoking, which will reduce the ability, the likelihood that you will pass away prematurely. You can also build wealth. So it might not even be necessary to have life insurance or to have as much life insurance as you otherwise might need. Bill Gates is a good example. He doesn't need life insurance. He's got plenty of money. If you had $2 or $3 million, quite possible, and adult children or children in their teens, quite possible you won't need life insurance. There may be other forms of insurance that might be relevant to manage other risks, but it's an example where life insurance is just one tool of many for managing a very specific type of risk. So this chart I'm going to talk a bit about income protection as a unique form of insurance that many people kind of overlook in terms of its importance, in terms of protecting you and managing important types of risk. So one of the exercises I go through with clients is I go through what I refer to as a forecast. And I use that term deliberately. We're trying to forecast their future, but I use the term forecast because there's no way of the only guarantee I can give is that it will be wrong. It doesn't stop it from being it's still a useful exercise because it does give you a sense of what your trajectory might be if we make various assumptions, and it will also give you some perspective in relation to some of the decisions that you might make, trade-offs involved, and the long-term impact of those decisions. So this particular forecast, we've got someone the age of 39 accumulating assets fairly steadily. They might take a sabbatical off for a period of time, or maybe they've got additional expenses in relation to their children that they anticipate, and then at a certain point as they head towards retirement they might be facing tailwinds. The empty nesters able to accelerate their savings. Then over the course of hopefully a long, healthy, happy retirement, they slowly accumulate or spend some of the capital that they've accumulated to support their lifestyle. This scenario assumes that they'll retire at the age of 65. This scenario assumes they retire at the age of 60. Big difference. Now, one of the things to keep in mind when it comes to retirement is it's so easy to think of retirement in voluntary terms. Many people retire involuntarily, unfortunately. Some people might do it because they're displaced from the workforce. Unfortunately, retirement for many is a euphemism for being displaced from the workforce. Somebody's made redundant, unable to find a job, or a job nearly equivalent to what they had as they were heading into retirement. Some people have to retire because of health issues. It might be fine if it's covered because of an accident. ACC may come help out. But if you have to retire at the age of 60 because of a health issue, you could potentially end up in this scenario when you're on track for this scenario. Now, there's lots of other factors in place. Maybe you would reduce your expenditure if this happened so that you would be able to sustain a better quality of life, sustain your capital over a longer period of time. Maybe if you're unable to work for 5 years, your longevity might be impacted. Hopefully, maybe you'll make some decisions like downsizing your home or anything or something of that nature. Hard to predict. Again, that's what it's about with planning. You don't know what the future will necessarily hold. So income protection insurance is one way of managing this particular risk. So you can pay premiums to an insurer to take on this particular type of risk. So you might end up with slightly less by the time that you retire because some of your money that would have otherwise gone towards savings will go towards income protection premiums. But you're potentially avoiding this risk. And for many people, that is the best investment they can possibly make. So just to reiterate, we don't have a crystal ball. Plans are worthless. Forecasts are forecasts. Only guarantee I can give is that I'll be wrong. But planning and thinking through these things is everything. So I'll finish up very briefly and reiterate this question. What does wealth mean to you? And I'm going to impose some of my own values in terms of some final recommendations in terms of how to invest. I think you should invest in yourself. One of the things I've found is resourceful people, they end up in a better financial position, and even if they didn't, they'd be able to work around it. Try and be as resourceful as MacGyver. Invest in yourself. Think of it from the perspective of your patients as well. Not sure whether I'd want to work or be friends with any of them, but I'm much more likely to want to get to know the column on the right than the left. Invest in your relationships. When I ask people, what are the most important things in life? What gives them the most value and the most joy? It's almost always relationships. It's not about having money in the bank. Invest in your health. When I prepare advice, I ask people what they do want out of life, but I also ask what they don't want to happen. What's the scenario that would keep you up at night? And it's almost always got nothing to do with money. It's about their health or the health of their loved ones. Again, you don't need to take insurance to help manage this risk. You can make healthy lifestyle decisions. Sometimes it's worth spending time and energy to make sure you invest in your health. I want to finish off with a quote from a famous philosopher, Jim Carrey. Probably well aware, he was one of the highest paid Hollywood actors for many years. He got pretty much everything he wanted. And he said, I think everybody should get rich and famous and do everything they ever dreamed of, like he did, so they can see it's not the answer. Wealth is not about money. It's not about how much you're worth, what's in the bank. That's a tool. It can help you achieve the things that you want. It can help you live the lifestyle and live in line with what genuine wealth is to you. But I want you to ask, what is wealth to you? And what are you investing in to live the wealthiest life that you possibly can? Again,